Bonjour, Namaste, Shalom. Welcome to our session today, where we will be chatting with Mr. Pankaj Singhania, author of the book Stock Lingua, Common Sense Investing, published by Vitasta. Mr. Singhania is co-founder of Lakewater Advisors, a portfolio management company based in India. He is a chartered accountant by training and a former civil servant. Pankaj, thanks for taking the time to chat with us today.
Thank you.
Thank you, Pankaj, I will start with some questions, and after a few questions, we will open the floor to questions from the audience. Because the interview is in English, we will ask the audience also to ask questions in English, whether they ask through the chat box or through the video function in Zoom. So let me start with the first question. How would you describe the book in 30 to 40 seconds to someone who's not yet read the book?
The book is Stock Lingua, which means language of stocks. This is about principles of investing in equity. In general, we find the retail investors often make serious mistakes which ruins their wealth. So of my 30 years of investing journey, I found certain principles which are very basic to investing. So someone who goes through this book will definitely be a better investor once they follow these principles which have been elaborately laid out in this book. So this book is meant for investors who want to get into equity market, the novices. It's in a very simple and very layman language without much complexities.
So Pankaj, I do agree that the book is written without much complexity. That was my understanding when I read the book. But what motivated you to write a book about how to make money in the stock market?
This is part of my journey of I've been into investment for a long time now. So lot of experiences, lot of mistakes, lot of good practices that I got through in my investing journey. So I used to keep jotting down whatever lessons that I learned out of this. So whenever I used to discuss with my friends, my family, my other colleagues, we used to discuss on those points which I got out of my experience, which we should avoid in market or we should take care of while investing. So I never knew all these years this jotting down took shape of a book. So a friend suggested why not to put it into a form of a book, because these experiences are really valuable. So then it struck to me, okay, let us put it in the form of a book, took help of friends, and finally Stock Lingua is before you.
Okay. And what are 3 to 4 things that you would like people to learn from this book? The book itself is, of course, long, but 3 to 4 fundamental takeaways that you think they should pick up from this book.
As I told Vishalji, his book is about principle of investing. So there are a lot of lessons for first-time investors or the retail investors which they can learn from this book. And putting down in 3-4 points, what reader of this book would take is, what I advise them is, generally retail investors should not do direct investing in equity. It's risky. They should take help of professionals or the financial institutions who do their work, who do their research thoroughly. Unlike the retail investors who do investing on hearsay. So the first lesson which the book teaches you is to take help of professionals. Second, in our investing journey, we should not only focus on one asset class, but that should be diversified. Your money, your wealth should be invested in a different asset class rather than focused on one. Third, you should do your own reading. You should do your own study once you enter the field of investing. Because even while choosing the right managers, the right institutions who will handle your fund, you should have the basic knowledge of investing. So this is what in nutshell the book will let you know or teach you.
Okay. So on page 71 of the book, and now we'll go through some of the things you talk about in the book. On page 71, you mention casual, passive, or uninformed investors. Isn't it true that most stock markets around the world, the typical retail investor is casual, passive, and uninformed? So how would you describe the typical investor if that's not the typical investor?
You are very right, Vishalji. That is the truth. That not only in India, but globally, the general investor, the retail investors are casual in their approach, they are uninformed. And that is the reason why almost every time it is the retail investors who are victim of the market variation. That is because if you study the behavior of retail investor, they generally invest on hearsay rather than study or research on the product in which they are investing. If you study the behavior of these retail investors, it's more on hearsay of friends, of the brokers, and rumors too. Because the speculated stocks in the market, often that is associated with a bull run. So these speculated stocks are very well placed. They are among the retail investors. Very articulately they are placed to befool these retail investors, because they very well know they do not do the research, they do not study it, but they can be convinced by placing stories, attaching stories to those stocks. So this is the general behavior of retail investors globally, not only in India. And that is what our book let them or teaches them. This uninformed behavior or this hearsay pattern should be avoided, and basics of investing should be clear before they enter into equity market.
Okay. So you write in the book that the stock market, and I quote you, the stock market is so complex that even the creators of highly complex econometric models, which, people who do finance degrees, they study these econometric models, and even Nobel Prize winning economists get befuddled by it. So that's what you say in the book. Given this level of complexity, how much confidence can a retail investor have in the capability of a professional investor to understand stock market, or even any simple framework for the common investor to use to make money in the market?
See, this complexity, this was actually a pun which I suggested in the book, that generally the stock market is presented before the investors as a very complex subject or something which is very technical. But actually it is not so complex or technical. In fact, I always say that what actually is a stock market? There is nothing called investing in a stock market, because there is nothing to invest in a stock market. It's only a medium to invest. Like I have narrated a story also in the book. Suppose I go to Ratan Tata with 5,000 rupees in my pocket and tell him, make me partner in your Tata Sons. What will he do? How will he react? But actually that is possible. Next day I go to market, buy shares of Tata Steel, and I'm actually owner of that. In AGM, I'll ask all the questions which a owner can ask. I'll get dividend, I'll get the share of profits. So this is what a stock market makes possible. That is the only role of a stock market. So we should understand what is the role of a stock market. We should not waste our time, or we should not get into more complexity of a stock market, but the underlying asset which we buy through stock market, that is a business. If we understand the business rightly, our investment will always be right. We don't need to get into the jargons and complexity of technical complexity of stock market. Rather, I always ask investors to focus on the business to understand the business right where they are going to invest. Unless and until you understand the business, unless and until you have the right perspective of the business, you should never get into investing in those companies or those industry. So that is what I meant when I say Kiana, it is very complex or...
Okay. On page 149 of the book, you compare Hindustan Construction with the company 3M. And you note that Hindustan Construction had revenues of 9,437 crores in 2019, while for 3M, the revenues were 2,986 crores for 2019 to 20 time period, for the same time period. You also write that Hindustan Construction has not had good stock price. And I quote you, the stock price in January 2021 for Hindustan Construction remains at a lower level than in January 2005. Given this, good revenues, but not so good stock price, how does one decide whether or not to invest in this company? The revenues are good, but the stock price is not good. So is that a good buy or is it not a good buy?
That is very true. Very interesting question you have raised, Vishalji. This is this example I have given in context of consistency. That often the investors get mistaken by the big revenue or big profitability of a company. But that is what I placed in the book. There are a lot of other factors which need to be considered rather than only the volume of turnover or the size of the company. If you see, I gave this example particularly because if you see, in past 10 years, the HCC's stock prices have not risen. It is the same. But in between, there are a lot of variation in the stock price. And that attracts the retail investors. And when that attracts, they get trapped. Because if you see the journey of 10 years, suppose from, I don't know the exact year, but from 2010 till today, there is no movement in the price of Hindustan Construction. At the same time, the 3M revenue are much lower, but still the stock price has gone more than 10-15 times in this past 10 years. So revenue or profitability is not the only parameter to judge where our stocks will grow or our investment will grow. There are many other factors which we need to consider. And that is what later I have explained that in the book. That consistency.
And for our audience,
yes.
For our audience, can you briefly summarize some of those factors?
Yes, like I often call such stocks as seesaw stocks. In our childhood, we all have taken a ride of seesaw. We move up and down, but we don't move an inch further forward. So these stocks are of such nature, more speculative. They will go 10-20% up, then again 50% down. But in your journey of 5-10 years, you will not see that price has gone anywhere. Majorly, this is associated with this phenomenon is associated with commodity stocks. Then most of the PSU shows the same phenomenon.
Okay, keep going? Yeah. Is there anything else you wanted to add?
Yeah, that's what this example suggested in the book.
Okay. So on page 114 of the book, you mention a lady, and I quote, who worked for 2 venture capital firms before joining academia to do research. And she researched one particular aspect that she had noticed at those firms. Could you tell us who this person was and explain to our audience what she noticed?
This is with regard to that venture capitalist who left the venture capital fund and then went into research in a top research firm in US. This lady used to work for a venture capital fund, and she noticed something very interesting over there. This again, I'll set the perspective in which this has been narrated is, in one of the principles of investing, I always say that character of management is very, very important. Integrity of management. Because if the management of the company lacks that, however good a company is, the shareholder is not going to get anything. So this lady who used to work in this venture capital fund, she noticed a very surprising thing in the firm, that when the business proposals used to come for investment to this venture capital fund, and all this business pitch went through all the levels and got passed. The venture capital funds were ready to invest in these businesses. They passed through all the business parameters for the venture capital fund to invest into it. But what she noticed is, at the last stage, when this venture capital fund used to meet the key management personals of those businesses, what she noticed is most of those investment proposal didn't went through after the meeting with the key management personnel of this venture capital fund. So it was a very surprising this thing. When everything passed through the pitch of business, through all the business parameters that went through, only through by meeting the last leg of meeting with the management, the proposals is not passing through. What's the reason? So finally in the research, they found out that the most important part was, in the last meeting, the board of venture capital fund didn't got convinced. The trustworthiness of the business entrepreneur was shaky. Through their behavior, through their talk, the venture capital fund couldn't get convinced for their trustworthiness and their character. So all this business, after passing through everything, they didn't invested in those funds. Just for an example, how they judge it. For one of the example, how they went to judge this. When this management used to come to the venture capital fund for pitching their investment, for pitching their business, their main focus was on investor value rather than the core of the business. If suppose I am passionate about my business and I sit before a venture capital fund, I'll talk passionately about my business, how I am going to grow, how my product is going to get benefited, how my services are going to benefit the society. But the main focus will be creating how our multiple are going to increase, how will second leg of capital raising, how will do that. So their focus is entirely different, which is enough to make the venture capital board judge that the management is not focused on the business rather than. So this is one of the aspects. There are many other aspects which got established in the meeting, that the character and the trustworthiness is not right of the management. So this is what this lady went for the research and established that. This is a very interesting.
So Pankaj, let me ask you a follow-up question to this, to your answer. How is a retail investor or even a professional investor expected to evaluate the trustworthiness of the promoter of a large firm, given that in today's environment, there is no one-to-one interaction between the promoter and the retail investor in most cases, and even most professional investors never have one-to-one interaction?
See, the image of the management is not only established by one-to-one interaction. Just for an example, if I ask you, what do you think about Tata Group in India? Your response will be very positive, though you would have not interacted with Ratan Tata, I think. But still, the image carries through several ways. It's not only one-to-one this thing. So I always ask retail investor, if they are doing direct investing, so not to move beyond such management. If they are moving out from such management, they should invest through professionals. And if they are investing directly, they should choose management whose credibility, integrity is well established in public forum.
Okay. So if you don't mind, another follow-up question.
Yes, please.
In India, the Tata Group is sort of an exception when it comes to reputation. Just like in America, Warren Buffett, who is the head of Berkshire Hathaway, he is sort of an exception when it comes to reputation, right? But most promoters don't have the benefit of having the reputation of Ratan Tata or Warren Buffett. So then that leaves the retail investor with very small, with one or two people to invest, isn't it?
No, it's not one or two. Still the size is large. Tata is there, Infosys are there, Godrej are there. There are many. You cannot. There are many in India, which a retail investor also can easily say that. But that is what I said. Retail investors shouldn't go for direct investing. They should go through professional management who have done their research thoroughly.
Okay, so that's very good to hear that there are several companies in India where the promoters have stellar reputation, and you gave some examples: Godrej, Tata, Infosys, and that's the kind of companies people should invest in, and not look for seesaw stocks that may take them up but also take them down very quickly. So thank you for that. Now on page 166 of the book, you mention, and I quote you, the biggest obstacle to wealth generation in the stock market is to give in to the greed of becoming super rich quickly. Could you please explain that? What kind of time horizon, if not quickly, what kind of time horizon would you recommend to retail investors?
See, again, I'll come to my former point when I said there is nothing called stock market investing. We invest in the underlying business. So tell me one thing, which business we said which grows multiple in a short period of time? Never. Business takes its time. We have to be patient. We have to give time for the business to grow. Unless and until the business grow, how can the stock related to that business can multiply? We have to be patient. We generally look for a time period of minimum 5 years for a stock to give you returns. So 5 to 10 year horizon is should be minimum for a equity investor.
So are you suggesting that people should buy stock in a company with good reputation of the promoters, trustworthiness, and then they should plan to hold the stock for at least 5 to 10 years?
Yes, of course. You will have to give time for the business to grow. It cannot happen in a couple of days or months. If we can see the chart of many such companies which are multiplied, we'll see the chart pattern is the same. Initial period will be slow, but then suddenly we'll say that the business starts growing up. Equity investing is never about short run or this thing. It has to be given time. 5 to 10 years
Pankaj
is for business to grow.
Pankaj, you do know that a lot of investors tend to be short term, right? So your advice that stay with the company for at least 5 to 10 years, I think is very good advice.
Yes, and the wealth will be multiplied if you have that kind of patience with you. And in short run, I think almost 99% people lose their wealth. Yeah. That is the key. The patience is the key in wealth creation.
And that's what Warren Buffett and some of the other investors say, right? That the stock market is not for the short-term focused people. Yeah. So let me move to the next question then. In chapter 8 of the book, and those of you who have not read the book, I encourage you to read the book. When you read a book, it's not necessary that you agree with everything in the book, but when you read a book, keep in mind that this is written by someone who has expertise in that area. So it's worth considering their writing. So in chapter 8 of the book, you provide several examples of Indian companies that failed because of high debt. You also mentioned debt to equity ratio as a metric to assess the health of a company's debt. You are a professional investor yourself. Can you explain how you use debt to equity ratio to make investment decisions?
See, this is a very important ratio while we take decision for investing. This carries the highest risk when we invest in a company which is highly leveraged. And in Indian context, it is more relevant because in past 5-7 years, we have seen the most of the debt-ridden company which have gone bankrupt and today reeling under NCLT for takeover by the new investors. When a debt in a company is very high, your obligation to serve the debt is consistent. Though your earning might vary, but you have to pay interest on your debts. That's a permanent liability. And for past couple of years, means past decade, I would say, most of the Indian companies were highly leveraged. It was easy to take loans from bank, which have been curtailed, and now it has been made difficult. Most of the company that has went bankrupt were highly leveraged company in India. And company which have been successful, if you see, they are almost debt free. So one of the important parameters when we invest into a company is to see how leveraged the company is. What is the debt level of the company? Once the debt is low, we can be assured of that risk level of the company is low, because the interest service obligation is low for that company. Hence, we should avoid highly leveraged company or company which has high debts. You take the names of most of the prominent Indian business houses like SR, Videocon, the Anil Ambani group. There are many such which bankrupt because of debt. On the other hand, it's not always debt-free companies are good, but the right ratio of debt equity is important. It shouldn't go beyond, and that depends upon industry to industry. The same ratio of debt equity cannot be applied to all the industry. The same like financing companies, they will always have a high debt equity ratio. So that is one of the important aspects we should keep in mind.
So what I take from your answer is, look at debt equity ratio, but don't look at it blindly. Debt equity ratio that is desirable will vary from industry to industry. Mm-hmm. And so understand the industry fundamentals as they apply to debt equity ratio. Is that correct?
No, that's perfect.
Can you give us an example of any one industry in which you invest as for your retail investors, and tell us what the debt to equity ratio is that you sort of like to see in that industry?
See, like one of the industry, you take the example of Infosys, which is debt free. And next example you take of Bajaj Finance, which has huge debt. Both the companies are equally good, because the nature of business, the nature of industry is different. Infosys generate a lot of cash. They look for avenues where to invest rather than taking debt. Whereas Bajaj Finance needs further debt to grow their business. So one is highly leveraged, other is zero leveraged, but both are equally good. It depends upon the nature of the industry.
Okay. So in chapter 9 of the book, you talk about avoidables. What are avoidables? And is that a term you coined?
Yeah, that is one of the chapter in the book where we highlighted certain sectors which we ask investors to avoid. Out of our experience, one of the avoidables which we have mentioned is commodity business. See, commodity business is cyclical, and I have found a lot of retail investors, they get trapped in this commodity companies because they are very alluring. You will find the money multiplies in a very short period of time, but it also destroys your wealth in a very short period because it is cyclical. Hence, we always suggest not to get into commodity industry. One more avoidable industry which we suggest is which does not matches with the social ethos of that country. Like in India, liquor or tobacco is a social taboo, where while in US and those countries it's not. So it is safer over there. But in India, you can expect anytime government might come up with any new taxation or any ban, liquor was banned in Bihar, in Gujarat the liquor was banned. So that again destroys investors' wealth. Why to get into such industry? So these are certain avoidables which we have noted in the book for investors to avoid.
Perfect. And I truly hope that avoidables, which is the topic of chapter 9, and debt, which is the topic of chapter 8, will be taught in more business schools in India, because I think that is a topic that business schools in India, those two topics, they are not covering. I hope your book sort of pushes some professors to start covering that topic in the business schools in India. Now, before I move on to the next question, I would like our audience to use the chat function to ask questions, or to feel free to raise their hand in Zoom, and we can ask them, we can let them ask questions on video if they want. But my next question to you, Pankaj ji, is what was the reception to the book when it came out? This book is about investing, stock market, and as you rightly note in the book, not many Indians invest in the stock market currently. The percentage is very low. What was the reception to the book, and was it along the lines of what you expected?
It was beyond my expectation. I never thought that book would receive such a great reception. It was initially launched on Amazon, and most of the time I got calls that the book has, the stock is no more there in Amazon, and the publisher had to replenish it every this thing. And I also got a lot of calls from very unexpected quoters about the book, and they even discussed. I also gave time for it was interesting to get their view. But frankly saying, I never expected that this book would take this big a stride, and I'm loving to interact in one-to-one also. I get a lot of calls in the day regarding the book. So I'm excited. Yes.
So Pankaj, in the book you talk about how Indian participation in the stock market is on the lower side. So what is the current percentage, and where do you think it should be for India to have a vibrant, dynamic stock market?
See, as compared to developed countries, we are not even 1/10 of what the general participant in the US is. So the depth is very, very shallow in India, and there is huge scope of the market getting percolated to the lower levels. One of major reason till now has been that the ethics in stock market has never been up to mark. We all know the scams and other this thing, which have eroded the confidence of general investors in India. But after the establishment of SEBI, and in past 5-10 years, if we see, it has become such a strong machinery to protect investors' interest, that I think slowly that confidence is getting back in the Indian market. It is very well regulated market today than it was 5 to 10 years back. And the depth of market is also increasing, with lot many companies getting listed every day in market, and very interesting businesses which are getting listed. So I think the depth will increase in India with coming time. There is huge scope for that.
And do you think the regulation in the stock market in India today is comparable to that in the best stock markets in the world? Or do we still have some way to go?
I can blindly say that. Too good. The SEBI today is one of the best governing body in India, I would say.
Okay, that's good to know. Now, let me ask you something about your own writing of the book. How long did it take you to write the book? How did you keep yourself motivated, on track? You have a day job. I'm assuming you have a family that demands your time. So how did you keep yourself motivated?
See, I told you it was a journey for me. I never thought of writing a book or such. I kept jotting down the wisdom which I gathered in my investing journey. And when it took form of a book, I do not know. During the COVID period, I think it got, I spend most of my time, my son is in college now. So when I used to talk to him about investing and these principles, he only suggested me once, why not you give it a form of book? So all these jottings for all these years eventually took shape of in form of Stock Lingua. So it took, I started writing, and during COVID period, it took 2 to 3 years for me to write.
So Pankaj ji, you just mentioned that your son is in college. Is he interested in the stock market and investing? What steps did you take as a parent to interest him into investing in stock market?
Not investing, he is still in college, he's doing his law. So he's more interested in law rather than investing. But what I think is that everyone must have knowledge of investing. That secures your future. In whatever profession you are earning, you have to invest a portion of it. Whether you are doctor, engineer, lawyer, in any profession you are. If you are not doing the right investing, you cannot keep on earning lifelong. After a time you retire and your wealth keeps a good life sustainable. So I always ask, you are into any profession, you should have the basics of investing right, and you should know the basics of investing. With that intention, I used to talk to my son about this. And that is where this idea of writing down this book came.
So Pankaj, I completely agree with you. Whatever job one does, one should save and one should invest. However, when you look at investment options, many people in India believe that the real estate or gold is a better investment than stock market. What would be your sort of message to them?
See, I always say your investment should be diversified. And putting it in a formal thing, I would suggest whatever wealth you have should be categorized in 4 segments. 1/4 in real estate, 1/4 in commodity in form of gold or silver or any jewelry and commodity in any form. 1/4 in cash, FD or bonds, the fixed income yielding securities, and 1/4 in risk-bearing equity. So this is the 4 segment in which you should keep your wealth divided. So that will hedge you against any upcoming risk. If there is a fall in commodity, you will find gain in equity or real estate. If there is fall in real estate, the other segments will give you a better thing. So if you follow this chart, I think it will well take care of your future.
And is that 25%, 25%, 25%, 25% dependent on the age of a person, or it's irrespective of age?
It's irrespective of age. Only thing is, if you are too young, equity portion can rise to 30%, but more or less the percentage should be same.
Okay. So now we move to sort of the last few questions of our interview. As a writer, and I know you said you did not set out to sort of become a writer, you became a writer sort of by destiny or accident. But were there other good writers who inspired you?
I've read couple of, definitely. One of my initial book that I read on stock market investing was of Ben Graham, that was Intelligent Investor. That was a wonderful book on investing. And of the same author, Ben Graham, there was a book, his initial book, I think, that was Securities Analysis. That is the basic of stock market investing. I should think everyone should read that book. And that also second edition of that book. Securities Analysis is second edition. There were many more editions after that, but the second analysis is the foundation. One must read that. So basically on this, Ben Graham, I have read Ben Graham more on equity.
And is it correct to say Ben Graham is the same person who's the sort of mentor or inspiration for Warren Buffett, the most successful investor worldwide?
These forwards have all been written by Warren Buffett.
Okay, perfect. So what books are you reading these days?
Finance, so I keep on reading the top journals, the magazines and the articles of many renowned this thing. But other than finance, also I am interested in reading fiction, history. History is one of my favorite, other than finance. So I've read couple of Amish Devgan's The Immortals of Meluha, I finished that last month. Right now, I am reading Conundrum by Anuj Dhar. That is a book on Netaji's death mystery.
Yeah, Anuj Dhar is famous for his writing on Netaji's death
Yeah,
or disappearance.
They have done a lot of research on that. An interesting book, very interesting.
Perfect. So my last question, are you working on another book, or so what's the next book?
It's I've already started working on a book that similar like to Stock Lingua, it's business lingua, where I've analyzed a lot of businesses which have been highly successful. So I've got getting into the intricate details of those businesses, what made them successful, and also a couple of businesses which failed in spite of all the positive ecosystem they were in. Still they failed. What were the reasons of their failure? So I'm analyzing many such businesses into intricate details, and I'm working on that.
So Pankaj, we wish you the very best for your next book, and I look forward to reading your next book, and I hope our listeners on the live conversation today, as well as those who listen to the recording of this, will also take the time to read this book and the next book that you write. Thank you very much for giving us the time today.
Thank you, Vishal. Thank you.
Take care.
Thank you.
Bye-bye.
Bye. Thank you.
And thank you everyone for taking the time to join with us today. See you next time.
Thank you, Vishal.